Today's topic is about how to find turning points for individual companies. As you know, every company moves with a unique pattern because it all depends on the nature of business, the market, the products, and its management. When you take consideration of a combination of these things, it becomes too complex for an outsider like you and me. So in this video, I'm going to present you with a different angle to look at things. First of all, you have to tune in to the external environment. This is very important. That is, you have to see the big picture. Why we have to see the big picture? Because no company is immune from the economic conditions and the mood of the stock market. And as you know, during bad times, it pulls down the stocks, all stocks. And vice versa. That means during good times, every stock will tend to go up. And even you look at the high flyers, during bad times, the high flyers cannot fly that high. And in good times, they fly even higher. There are companies we call consumer staples. They vary within a very narrow range. These companies have something in common. They all have a long history. They all have a large size, very diverse products and markets. They pay good dividends, and they have well-recognized brand names. That's why their stocks are fluctuating very little. They are immune mostly from the general economic environment. So you may say that they don't have a very obvious turning point. So what are these companies? Procter & Gamble, Kraft Foods, starting with a K, Walmart, Coca-Cola, AT&T, Verizon, and many others. Now let's turn to small companies. Small companies are characterized by lower price, higher risks, fluctuating price, violent fluctuation, and the turning point is very hard to find, and their turning points usually last very short. You have to ask about survival. Are they able to survive during bad times? And do they reach a bubble during good times? These are the pertinent questions you have to ask. A lot of people tend to look at the small companies by focusing on the product they make. However, please note that when you think about a product is one thing, but how the market will respond to the new product is another. So you have to be very careful. A good product doesn't mean that the stock price will rise. For big or medium companies, they are characterized by higher price, lower risk, less violent fluctuations, and their turning points are more obvious. For big or medium companies, we also have to ask survival, but we know that they can survive better in hard times. Why? Because they have enough fats to cut. Simply by reducing employment and cutting other operations, most of the big companies or medium companies can survive through hard times. During a recession, all the big companies will be pulled down. So this is a good opportunity for you to buy big companies when there is a deep recession like the one we are having now. Another aspect you have to look at is that you have to look at the stocks from the point of view of the business sector. Which sector does your company belongs to? Some example is that during the financial meltdown, all the companies in the financial sector are being pulled down. especially the banks. But besides the banks, you also have some very big companies being pulled down, such as General Electric, which has a large financing subsidiary. Rising oil prices will lead to the prices of oil companies being pushed up, and also solar companies are going up. However, you have airlines and the travel industry suffering. Their stock prices are coming down. Another aspect about rising oil prices is that it fuels inflation, or the fear of inflation if there's no inflation. So all of these will drag down every stock. The stock market never likes inflation. Another sector you also want to look at is the high-tech sector. High-tech sector is characterized by volatile fluctuations. So it's very hard to find the turning points, but there are some very big high-tech companies. We call them the bellwether companies, like Intel, Microsoft, Hewlett-Packard, Oracle, etc. When the stocks of these companies rise, you know that the whole sector is doing fine. We also have to look at the intervals between turning points. In the stock market, you can see that the boom and bust cycles always occur one after another. If you have a bust, it will lead to a boom, and the boom will further lead to a bubble. And after a while, the bubble will burst, and all the stocks go back to bust again. Now, the bust, from the bust to the boom, the interval may be short, a few months, if the recovery is smooth. However, if the recovery is not smooth, it's very bumpy, the bust to boom cycle may be longer, and it may last for several months or a year or so. Like the current recovery we have now, it is very bumpy, so the bust to boom period may have some time to run. From the bubble to the bust, it doesn't take that long. It always takes just a few months, because everybody wants to get out. So you have to be careful when you buy during the boom time, because when it comes back down, it may be too late for you to get out. Now we come to the last factor, but this factor is the most important, which is the big guys' actions. We are not big guys, so we never know how they act. So that is the tricky part of it. Because when the big guys act, everything else that we have just talked about will become secondary. They are not important anymore if the big guys decide to act. In fact, all the turning points are initiated by the big guys. Let me give you just a few examples. If you look at the bank stocks have fallen quite a bit, but when you look at the history, they already started to fall since November 2007. During that time, the financial meltdown was not very apparent. Nobody saw the financial meltdown coming, but the bank stocks were already falling. Now, you look at the bank stocks now, they are recovering very fast since early March this year, because the big guys have decided to move into the big stocks, even though we are still in the middle of a recession and the recovery has only just begun.